Management of MCX-SX, Joseph Massey, who's MD and CEO of the exchange, joins us right now. Joseph, good to have you on the show. First up, just a broad outlay of what do you expect from the budget this time around?
Yeah, thanks very much. And the general expectation of the market is that there would be a reduction in the securities transaction tax so that more investors are attracted to the market. There is also an additional expectation that growth will continue to retain its focus, and as a result, maybe the scheme for RGS will be enhanced so that investors are attracted to this market. Something would be done for the SMEs and the debt market. By and large, we understand there is a fiscal pressure on the government, so increase in taxation seems to be logical. But I think the market expects that if growth somehow could be attaining greater focus, and we somehow do not raise any further taxation, as a result, with growth, everything else will fall in place.
Joseph, two-part question. We will come to the STT in a bit as well, but there is expectations that, or a fear as well, maybe amongst the participants, that the government may levy CTT in this budget. And while there was, there have been flips to and fro for this. If indeed that is introduced, how badly could it impact the volumes?
Certainly, we have seen a huge impact in the securities market ever since the STT has come. The entire business has migrated to options and away from both cash equity and futures. And since in the derivative markets, in commodities, none of these instruments exist, so the general expectation of industry is that the futures will get very badly impacted and the markets will either go outside the regulated market, both either global or maybe outside. There are rumors that it gets into the illegal format, and I think that fear is very real.
Yeah. So then my question really is that we heard KV Thomas speak about this as well, that FCRA bill could be passed in the budget session. Could something like that happen, that there would be CTT which would be introduced, but the fear of the volumes moving out of the regulated market could be curtailed by the FCRA bill being passed in the budget session, and therefore options being introduced for the commodity segment, and therefore the volumes could migrate to that? Is that a distinct possibility? My question really is, assuming that both of these things happen, do volumes take a lesser impact than what would they have taken otherwise if only there was a plain vanilla CTT introduced?
See, I think by and large there is unanimity in the market that Indian markets have to be seen in global context, and Indian markets must be made efficient. Imposing any taxation does not make the market efficient. So I think in global context, any imposition of tax on any market, either equities or commodities or for that matter any other asset class, will actually be dangerous, and dangerous in current times where one asset class could have impact on the other, because the end users could be very many end users could be common. That is one. Second important point is, even in STT, the entire market has been for so long expecting that both the rates should come down, and for the moment people are saying we can go back to the old regime, so that STT is completely out of the market. So the question of what is not good for one market being good for the other, I think they are two different issues. Nothing can be done in a compensatory mode to say taxes come and another act gets passed, and so in future something could happen because of those acts getting passed. I don't think these two questions probably go hand in hand.
Right, but just coming specifically to commodities transaction tax, have you run through an estimate on how the impact of volumes would be if it were to be levied?
No, I think it would be incorrect to pose this question to me. I think it should be posed to the people in commodities sector, and I think my answer would be very hypothetical. But overall, I think if the impact in securities market has been negative, it would be even greater negative in the commodities market. A, because it's a global asset class. B, because the market is incomplete and relatively new.
Joseph, let's talk about MCX.
The impact will be very severe. That's the expectation of industry.
No, fair call. So let's talk about MCX-SX, and something that is probably off budget, but which will come into play in March. I believe your liquidity enhancement schemes, which start from the 6th of March. Do you see volumes picking up meaningfully? Because still now, you will also admit that it's been a bit of a slow start for your exchange.
I think exchanges always start in this manner. and there are no magic possible in an exchange. Exchanges are infrastructure institution. Each broker has its own business plan, and you keep taking one step at a time. And I think we've done all the right things by getting the market to this level. We've got about 400 people who are cleared by SEBI, or almost 250 to 300 of them are actively trading on the market. So I think we've reached penetration, technology is stable, the products have come in, regulatory system has been working very well. So I think all the first steps have been taken. Now the question was to get the liquidity scheme in place so that we can attract order flows, and I think the expectation feedback that is coming from the industry is very positive, and we expect that from 6th onwards we will start seeing greater traction.
All right. There are, of course, some reports suggesting that the equity platform has not managed significant volumes. Reports are coming up on membership approvals, connectivity, and KYC registrations. Are the reasons for the same? What would you have to say to that?
I think the connectivity is not a challenge. I think people are very well connected, and so many members have got connected to the market. KYC always takes time because it's a relationship between a broker and a client. We already have very significant number of UCCs already done, and so it's gradually increasing. And we have actually considered this in our plan that people will come in gradually. We must keep doing the right things. We must put the infrastructure in play. We must continue to attract the attention of the investors and the members. And our liquidity scheme that way has been very unique. We have ensured that there is enough for the investor, the dealer, the jobber, the broker. Everyone has something in the scheme. The entire focus of the scheme has been to get good, original, sticky business on the exchange so that we have sustainable volumes, rather than some exchanges have tried to use the liquidity scheme and we've seen the trading has been very skewed. We would like to not commit those errors. So I think we are very happy with what we have done and what we expect to see from 6th onwards.